Hi, everyone. Welcome back to LogTech Live. I'm Eric Johnson, your host. When I'm not here doing my twice monthly show, some of you may know I am the senior technology editor at the Journal of Commerce. But on Fridays at 10 a.m., every other Friday at 10 a.m., I am your host for LogTech Live. Delighted to be here. Delighted you can join us. If this is your first time, welcome. If you're a regular viewer, thank you so much for the support. I really do this show for all of you. A little bit for me, it's fun for me too, but mostly for you. Um, we are literally a week out, less than a week out. We're 6 days out from TPM Tech starting. It's starting at 10 a.m. Pacific in Long Beach, California, next Thursday, the 23rd. I've been talking about this for so long, I can't even remember when I started talking about it. But it's obviously, this is a multi-month planning process. And so I'm super excited to be able to say that we're really close to this actually happening. Second year that we're having it. There's a code flashing on your screen. There's still time to come and register. EJTPM 25 gives you 25% off a pass for that event. We have an amazing agenda. Uh, I personally think it's the strongest set of sessions talking about global logistics technology anywhere in the world. And obviously, we have TPM following soon after, the Sunday after. It's going to be massive. And I mean that like literally and figuratively. We have more people than ever. Every new registrant is a new record for us. You really need to be there if you're in the container shipping industry. Um, and that's all I'm going to say about that. Also, a couple of other events that I'm going to be at in the coming weeks. So, in end of March, I'm going to be at the World Petrochemical Conference, which is put on by our parent company, S&P Global. I will be leading a couple different sessions there, looking at some research that was done into logistics technology, sort of investment plans and usage as it relates to petrochemical shippers. And then I'm going to be doing a session about what technologies are sort of in the mix for shippers and carriers of chemical products. So definitely join us in Houston if you can make it to that. Follow up with me. The event I'll be at within the broader conferences on March 21st. If you follow up offline, I think I can get some sort of code discount on that too. And then in April, the JOC's Break Bulk and Project Cargo Conference will be held in New Orleans, the Big Easy. If you missed Mardi Gras next week, you should come in April for the Break Bulk Project Cargo Conference. I'll be leading 2 sessions there as well. And same thing, reach out to me and I'll see if we can work something out on a code. But I'll be, as usual, leading a couple technology sessions, and there's some interesting stuff going on in that sector. So please join us in New Orleans if you can. A couple other things. I put a note out on LinkedIn today. I have not done a LogTech letter since I want to say like mid-January. And the reason is time. I just have had no time. It takes time for me to do it. It's not something I can turn around in 5 minutes. And I don't want to do a half-assed job at it. So I'm on a bit of a hiatus through TPM. I promise I will be back mid-March with a new LogTech letter, and from there on, I'll keep it running, the train running like normal. So just didn't want you to think I had forgotten about all you people who love that newsletter every Friday. One last thing before I get to the news of the week. I'm wearing a T-shirt that Sarah and her team sent me. This is a project that she does, an initiative she does, the Blended Pledge. I talked about it last show. I'm going to talk about it again. This is a initiative that helps people, underrepresented populations within the logistics industry, who want to travel to events or get invited to speak at events, but don't have the travel budget. Their company's not supporting them. But it's about getting better diversity on stage, getting better representation at industry events. It's a fantastic cause, and someone out there needs to support this, not just with a few dollars, but just own this particular subject. Get a big dollar amount to Sarah and her team so that she can fund a whole bunch of different people's travel, so we can start to better represent
the industry on stage and not have it be a bunch of people who look like me only. So with that, let's move to the news of the week. I have 5 minutes, and there's more news than I can cover in 5 minutes. So this is really going to be the lightning round. 4 stories I'm going to talk about. This one just happened literally while I was at dinner last night. I was having dinner with family, and then, WiseTech decided to drop a $400 million acquisition in my lap because it was morning in Sydney, I understand. Huge acquisition. This comes just 3 weeks after WiseTech made in another North America-based acquisition of a drayage TMS provider called Envase Technologies. It's a roll-up of a bunch of different drayage platforms, drayage management platforms. Bloom is sort of the preeminent provider of data around chassis and intermodal equipment in North America. They have other solutions beyond that, but that's probably what they're most known as. Big dollar amount, big kind of deal from an extension of WiseTech's existing capabilities. I sort of just scratched the surface with this story because we were trying to pop this up on the site as quick as we can last night. More to come on this. Synergy, WiseTech, Gene Gander from WiseTech Global is going to be one of the speakers on the first panel at TPM Tech next week. So I will absolutely be asking him about all the major acquisitions that they have been doing. And I didn't plan that out. I invited him way before they made these 2 big deals, which collectively are for about $650 million. So pretty significant investment. Next story. Any other week, this would be the lead story. Chris Kirkner, here he is speaking at TPM Tech last year. Didn't know he was going to be missing payroll. Didn't know he was going to be let go by Slink's board. Didn't know he was eventually going to be, charged with a bunch of different frauds, fraud allegations by the SEC, U.S. SEC, by the FBI. He seems to be in a bit of trouble. The SEC filings are out there, excruciating detail, not just about what he did, but about some of them, what they allege are misrepresentations of the revenue that Slink was bringing in. And it kind of cuts to the heart of what we're going to be talking about a little bit later. I have a great guest in the venture capital world. And to a certain extent, it's the industry is set up for, in some ways, for founders to sort of inflate or kind of exaggerate numbers in order to lure investors into thinking that they are onto something big, right? So there's 2 sides of this. There's the did he lie to investors? Did he sort of exaggerate what Slink was all about? And then there's the whole other part of this, which is he took money that was invested in the company and used it for personal gain, allegedly, reportedly. So it's important to separate those 2 things, I think. But it's an interesting kind of window into sort of what can go on when things go off the rails. Next story, another big story. Normal week, this would be the lead story. Earlier this week, 9 of the top 10 container lines all said that by 2030, they will be 100% using electronic bills of lading. Very small little niche part of a huge global shipping industry, but really important. Electronic versions of documents. Look, we sign mortgages using DocuSign, right? We don't sign or paperwork, right? We still do paperwork too, but you commit to massive spend on a personal level through an electronic document. The title of goods for a few $1,000s is still often on a paper bill of lading. So huge potential from an efficiency perspective, from a data accuracy perspective, and then a usage of data once it's structured in an electronic form instead of on a physical paper that's being flown around the world and conveying title of the goods. Huge benefits right here. So very interesting to see most of the top 10 container lines committing to doing something. It feels a little bit like the
decarbonization goals. So it seems like it's kind of far out, but 7 years will be here in no time. And then last one, I'll just really quickly mention, again, this might have been the biggest story of the week in a normal show, but it's only fourth this week. So last week, Flexport unveiled an app on the Shopify marketplace. Very interesting. They're targeting kind of the Shopify small, digital storefront type of businesses that have no idea how international logistics works. It's intended to give them sort of a quick tool that gets them quotes and tracking on those shipments. This is not necessarily a tool yet for a company that is extremely sophisticated and has tons of shipping volume. This is for someone who has a storefront on Shopify and wants to either import a product or sell a product overseas and has no way to sort of understand how that works right now. So super interesting, and evidently the Flexport told me this is just the beginning of a relationship that they have with Shopify. Shopify invested in their last funding round in February of 22. So there's some strategic kind of connections as well on the investment side, which is a good lead-in to introduce my guest today. I'm delighted to have Paulina Banszerus. Did I get that right?
Perfect, Eric.
Cool.
Thank you
All right.
so much.
My German accent is not, I'm not noted for my German accent. So, Paulina, so glad you could join us. Paulina's head of venture capital at DB Schenker and joining us from Berlin today. Really glad you can make it to the show today.
Thank you so much for the invite. I'm super excited. And what amazing headlines, huh?
Yeah, there was no shortage of news this week. Kept me super busy. Kept me away from TPM Tech prep for too long. But it's fun. You as a reporter, you hate the weeks that there's no news. So this is like good for me. So I have a million questions to ask you, and we only have like 30 minutes. But let's start off. I usually start off with background because I think that helps people understand who you are, what you do, and kind of like what led you to the role that you have right now. So can you talk about what you do right now and sort of what you did before and how it led into the role that you have?
Sure. Happy to do so. It's certainly not a no-brainer. So I'm leading the venture capital department at DB Schenker. So I was hired end of 2021 in order to build up the CVC structure. I was working on the investment strategy, portfolio strategy, setting up the core team, and all the processes that were necessary to enable minority stake investments in the corporate. In the past years before joining Schenker, I've been working at venture capital, so really more the financial VC institutional investors. However, my background, my heart and where I come from is actually engineering. So I studied materials engineering at Aachen University, kind of made my way towards the investment area.
I remember when we first talked, I found it fascinating that you had that engineering background and finance background, and you sort of worked your way into logistics now. Super interesting. So we've talked a bit about CVC. We've had the head of Maersk Growth a few weeks ago. We had the folks at Zibox on fairly recently that are attached to CMA CGM. It seems to me that CVC, which used to be almost a bad word in the venture capital world, it's taken on a much more positive sort of connotation recently. And it seems to me that founders are almost gravitating towards CVC. What do you think about CVC has become more appealing? And then secondly, do you see Schenker's model as sort of traditional CVC or something a little bit different?
Good question. Certainly CVC had kind of a tricky reputation in the startup world. Yeah, so this is due to long decision-making processes, budget that is unclear. So basically the setup, how you structure your CVC is decisive for your success and also your reputation. I think nowadays founders as well as co-investors very much see the benefit of a CVC, because as a CVC you have normally you have a more narrow investment scope. You bring a lot of expertise to the table. You bring a network to the table that is not easy to obtain. And it brings benefits to, on one hand, the portfolio companies, but also to co-investors that kind of need a hand when doing a due diligence in a space they just lack the expertise. So I think the reputation of CVCs improved a lot over the last years.
Yeah, I agree with that. What does Schenker approach this from a, that there's a traditional sort of format for this, or do you think it's a little bit different in that,
Yeah.
you have a very broad, strong business, right? Like what do you approach it in the way that like a Walmart or a Siemens or, a shipper would approach it, or,
Fair question. I don't think there's a traditional way of having your CVC.
Okay.
I think there are a lot of variations. So it begins with whether you have a fund structure or you're a department within the corporate. Do you have a dedicated budget? Are you evergreen? Are you off the balance sheet every year? So there are a lot of kind of variations you can take. And I wouldn't know what is the traditional form. Yeah, I think the variety is just too big. However, at Schenker, we have a dedicated budget for the next years. So it's kind of set up as a virtual fund structure. We're not in a fund officially, so it's not a separate entity, but all the processes behind it, so the decision-making process, the budget allocation, how we invest, so what are our investment criteria, this goes a lot more towards a institutional investor than a strategically focused CVC.
Yeah, interesting. And thanks for, I think one thing for people who in the logistics world who've kind of been forced to come across VC and are trying to understand it, there are degrees of difference between different VCs that just take time to understand. So that was super useful explanation of some of those nuances. So let's step back a little bit. Am I correct that your main focus is investing in startups in Europe, or do you have sort of a global reach in terms of where you're looking?
We are currently focusing on Europe. This is mainly due to the kickoff of the investment arm. Yeah. So as we have kind of the limited budget and limited team, and kind of we are driving an MVP of our CVC. We're starting with Europe with quite a focus on supply chain management and logistics. However, I'm very optimistic about broadening it in the future. And frankly speaking, logistics is an industry where this makes a lot of sense, and especially for Schenker that is active worldwide. Yeah,
it's a global industry, right? Yeah, it's perfect to think of it in those terms. What I'm curious, what do you see? I mean, I don't know what your exposure has been to sort of the VC environment in the U.S., but it's a very all-consuming kind of thing here. People here think VC here is VC globally, right? And everybody else is. How do you see the environment differing in Europe versus what goes on in the U.S.?
Interesting question. So to be frank, my experience with the US-based startup ecosystem, investor ecosystem, is limited as we are focusing on Europe. Yeah. However, I would like to share with you some observations that might be interesting. So first of all, if we have a company from the US fundraising in Europe, European investors get super suspicious, because it's seen that there's a lot of capital in the US And there's also the perception that it's easier to raise. Tickets are bigger. Investors dare more. So if a company couldn't raise in the US, we really get a bit suspicious here in Europe.
Interesting.
And the second observation is that European companies, so European startups, either if they want to raise bigger rounds, bigger tickets, so we go for Series B and C, or need more capital, or if it's in the area of moonshot technologies. So it's not the VC's darling software as a service play, but rather launching rockets. People tend to go to the US as well. So I think in general, you could say there's the perception that there's more capital in the US and that the investors are more daring.
So is it fair to say that it's interesting? I would agree that sometimes maybe too daring, right? On the US side, is it fair to call this sort of environment as a whole in Europe more conservative, or is it just more rational? Is that a right way to, how would you describe that? Because I've heard this before. So
it's a good question. It's certainly more conservative. I don't know if you can be really rational in the space of venture capital. I mean, it's venture capital, it's high risk capital. So risking is kind of your job. Yeah.
You have to have some appetite, right? That's true. That's a good way of putting it. Okay, so let's get into some of the areas that you think are kind of most interesting right now from a supply chain management or logistics perspective. What are you seeing as the most active areas that startups are investing in? And we're in an environment now where our industry is seeing a downtick in demand. There's just less freight moving, and that means everybody has a little bit less, profits and capital to play around with, right? So has that changed anything, or are you sort of looking at things on a longer term basis?
Yeah, I think I'll answer this question right from an investor and not from the industry perspective, but really as an investor. So what we've seen in the venture capital environment, that the economic environment overall, of course, influences the money, and the money is tight. So in the last years, very high valuations have been raised. Money has been spent like crazy. Due diligence was skipped. This is not the case anymore. Yeah, so pockets are tighter. So when it comes to logistics and supply chain management, and where startups should focus, or which startups have a better chance to succeed, I don't think that this is essentially a certain area in logistics or supply chain management, but rather characteristics of the business. So what we are looking for as investors right now are two things. One is immediate return on investment for the customer. So we're not looking at solutions for the market that will generate a benefit or return on investment in maybe 2, maybe 3, maybe 4 years, but we need solutions with immediate return on investment, because this is also where customers are more eager to pay if you have the immediate cost savings, for instance. Yeah. So this is one characteristic. And the second one is mainly the business type and spending type of the company. How capital efficient is this company? Where does this company allocate its capital to? Where will funds be allocated to? Is it like a crazy marketing game, or is it a high conversion from money spent into traction? So this is kind of what we're looking at. I wouldn't say there's a specific area we've shifted, but we are more focused on certain kind of businesses.
That's super interesting. And I think the first characteristic you were talking about, I often see referred to as time to value, right? Like the time to value has to be not typical of what we see in logistics software sales cycles, where it can be multi-month, sometimes multi-year process to land a customer, and that just doesn't work in the with the venture funded kind of approach. Is that a decent way to think about it?
Yeah, I think it's mostly thought from the perspective of the customer. Like if the customer use it, it will return either money or time, which is equal to money immediately. This is kind of the thinking. I think the logistics industry right now is not too open to test and trial and innovate and let's try out this, but rather, okay, I see there's a solution. I see it has a proven track record of saving cost or saving time. Happy to test that. But otherwise, I think companies are having a harder time landing their customers.
Very interesting. Well, so are there some specific areas that you are finding personally very interesting right now? Maybe something that, I don't know, has been sort of under the radar for a while, but now seems really relevant to the industry and is grabbing your attention more. So like, I'm thinking specific models or types of companies.
What I can share is that we are having quite a focus this year when it comes to our deal flow, and it's on climate protection. Yeah, so this certainly has been under the radar for quite a while. Maybe not paid attention as much as we should, but we all know the impact of logistics on our global emissions. DB Schenker has huge ambitions when it comes to climate goals. So carbon neutrality at 2040 is the ambition. There need to be investments. There need to be cooperations with technology providers in order to achieve this. So this is what we're focusing on with the deal flow team this year, and it really has a variety of angles how to look at. So it comes from very obvious angles, which are fleet electrification, alternative fuels. However, very interesting are also sharp solutions that optimize routing, optimize processes.
Empty miles driven, empty container usage.
Completely right. So there are a lot of angles how to tackle this, and we are working a lot with institutional investors that are focused on climate tech and exchanging here a lot. So gaining experience and technology insights here as well, kind of fusing it with our industry expertise and developing our investment thesis here.
Very interesting. Actually, the last guest I had 2 weeks ago was from a company called Nautilus Labs that's looking at helping vessel operators sort of significantly reduce emissions through better operational data. So I'm seeing just a ton of activity in that space, and it makes perfect sense for you to be, prioritizing those types of startups. So. Well, I do want to dig into some models that, I've seen. I sort of think of this as like a decade now into kind of the VC era of logistics tech, right? That's when we started to see venture capital start to get interested in various forms. And, there's marketplaces, freight rate marketplaces, there's data providers, tech-enabled 3PLs, there's sort of traditional SaaS enterprise software, just more efficient maybe, or more browser-based versions of systems that companies have long relied on. Is there one, or more of those models that you think is particularly well suited to VC, and conversely, are there ones that are just not well suited to VC?
Oh, interesting question, Eric. Certainly, the investor's darling is always SaaS. Yeah. This is because with SaaS, you have the scalability, software as a service. It's easier to estimate your valuations. It's easier to estimate your market entry. And you always, like after some time, of course, it depends on the maturity of the company you're looking at, but you either have or you don't have the hockey stick. Yeah. So SaaS is definitely the investors' favorite model, and I think there are two very good ways for SaaS entry. You either have a very smart market penetration, so you go very aggressively into the market, and you have a very good execution in the team. Or the second point is you have a very defensible technology behind your SaaS that is not easy to copy and brings a huge benefit. Of course, both under the radar of immediate ROI and good capital efficiency, but this is overall SaaS. What I think is very tricky for investors, most of all institutional investors, is tech-enabled 3PL services. What I think is tricky here is that these companies, because they are tech-enabled, they have valuations of software companies. However, they are not. It's not software companies the investors are investing in, and it doesn't have the same scalability. And sometimes it's a bit blurry, the line between, for instance, a freight forwarder, and a freight forwarder using good UX. You always need to be careful how much the tech-enabled part drives your margins. If not, it will be just another 3PL you're investing in. And I think it's very hard sometimes for venture capital, especially institutional investors, to get hold of this. Because as a 3PL, especially like, for instance, in land transport, you generate traction like nothing. I mean, everyone is looking for carriers. If you have carriers and you don't care about the margin because your business is backed by external capital, you will grow 3x, 4x, whatsoever.
Right. Yeah. Very interesting. I mean, I tend to agree, and I think there's been a slow realization from the investment community over the last decade that is a tricky model, right? It's a high revenue model, but the question is, what is the eventual margin on that revenue, right? So, very interesting. What do you think? So I think about this question a lot, and so I'm eager to get your thoughts on it. How do you sort of differentiate between a company that's exciting to you, like you look at it and you think, oh, this is a really cool company, I'm really excited about what they're doing, versus they have the characteristics that you mentioned before, they're scalable and they're worthy of venture investment? How do you sort of put your personal excitement aside and think about it, like, very pragmatically?
Yeah, actually, this is a very easy question and a very sad question. Because every business is kind of exciting. At least to me, I think it's exciting if people get together, realize an idea, put an idea into action, have first customers, build a first product, get into an industry. Like, I mean, this is amazing, yeah. And I'm happy there's so many people out there trying to build businesses. But they are businesses, and they are venture capital businesses. And venture capital is a different way of growth. And people need to understand that, because it's as easy as that. A venture capital backed company needs to aim for a 1 billion valuation. This is the size we're going for. We're not going for organic scaling. We're probably not going for sustainable organic growth. Yeah, it's really the hockey stick. It's high growth. It's mostly aggressive growth. And if you don't intend to build a company like that, if you don't care for like the Facebooks and Spotifys and want to have your small business, your family-owned small business, it's good, and we need those people. Not everyone needs to be backed by venture capital, but this is not venture capital. We need the 1 billion businesses. So this is what we go for when we assess a company, and this is where we very fast kind of tick the red flags and say, okay, this doesn't have a chance.
So it's really interesting because I think a lot of times I talk to a fair amount of investors, and I think a lot of times we are in similar situations in terms of me reporting on the industry and you know, looking at interesting companies. We're sort of in discovery mode. We're trying to understand what they do. We're trying to understand who their customer is. We're trying to understand what problem they're solving. Where I diverge from a VC investor is I don't care if the company is on a path to $1 billion or whether they're on a path to $100. I just care if they are talking about a problem that I know exists in the industry and they have a way to solve it, because then it's my job is to write about it in a way that's putting it out there for the market to do its own research and let the market determine whether that approach is good or not. You're in a position where you have to measure those characteristics about the business itself. I really only care about do they understand the problem? Do they have a solution to fixing it? Right. So that's why it's always interesting to me to get thoughts on that from an investor. So
yeah, I have a trick at Schenker. So yes, we're a CVC and we're financially driven, though in a strategic scope. But if they're companies that we really like, we think they work on a relevant problem, but it's just not a venture capital case, we still have our colleagues from corporate venture clienting. So we still have the opportunity to bring the solution to the industry. And we do that. Yeah, we do that. It's not part of our business model in venture capital. It will not generate my return. It will not beat my KPIs. But we still have the opportunity to work with them and to support them in a way, just not financially.
That's interesting, and that goes back to the whole CVC. You know, some of the benefits of a CVC that maybe don't exist with sort of an independent venture fund that's purely focused on returning the fund at a certain level, right? So, very interesting. Okay, a couple more questions. What do you think? I mentioned the long sales cycles that have sort of plagued the software industry and logistics. What do you sort of think is the biggest challenge facing startups in terms of getting to that point where they tick that box that it's interesting to you?
Oh, yeah, we are seeing so many challenges for startups in the market as well as our portfolio companies right now. So it very much depends on the industry segment you're in and the business model you're pursuing. So long sales cycles, as mentioned before, if you're a digital 3PL, that's not a worry for you. But if you try to get into maritime logistics, selling a SaaS, good luck. That's a tough one. What we see as well is that hardware companies are struggling a lot. So the supply chain issues that Schenker or our customers face, big customers, big names, imagine this for small customers, for small startups that try to procure a small amount of parts. Their prioritization with a supplier is down to bottom. Yeah. So they are really suffering. And if you don't have parts, how to build your product, how to commercialize. So this is very tough. And another challenge that we are observing with a lot of digital or a lot of analytics-driven business models is availability of data. So we see, especially here in Berlin, we have a bit of the pioneering spirit and a lot of business people going to the logistics space now and want to digitize it. The problem is, so there's analytics, but before analytics, you need the digitization part. Yeah. And Eric, I mean, you know the industry, you know that in a lot of segments, we're not that digitized yet. So when it comes to data availability, it might be that data is not available. This is one thing, and other things are that the willingness to share data or the incentivation to share data is often not given, and this is what drives a lot of business models.
Yeah, they're really relying on that, and it's not yet sort of an innate part of the industry yet. Really, really interesting. So 2 last questions. I love asking this question of investors. What do you think there's one thing that the logistics industry still doesn't understand about VC?
Yeah. So my biggest problem in my daily job is that they understand what we're doing. They understand that it's high risk capital, yeah, and that everything we're doing, the investment thesis we're building, it's not much more than an educated guess. Because it's nothing imminent. It's we're trying to invest in a company that will be a 1 billion valuation company 7 years from now.
Yeah.
So it's an educated guess. However, I think the industry needs to be more empathic when it comes to startups from time to time, because you can really rip them apart. If you look at their 5-year forecast, an early stage company with a 5-year forecast, of course you can rip that apart. Yeah, it's a forecast. Yeah, and they don't have a track record. It's all educated guesses. It's thesis is it's kind of going forward and daring. So the industry needs to be a bit more empathic with it and see more the potential than what can go wrong. Because let's be clear, everything can go wrong. Yeah, sure. Look, there's just been a pandemic or a war broke out or energy crisis, climate change. So if I think about what can go wrong, I wouldn't invest at all.
You wouldn't invest in anything. That's a great point. So it's a very optimistic industry. That's a good way to think about it, I think. Last question. Ask this of every guest. Who's your favorite musician or band? And you need to tell me why.
Yeah. That is a Brazilian artist called Seu Jorge. And Seu Jorge he's known for samba pop or popular Brazilian music, MPB as it's called. He has a very deep voice, and he was a street artist who learned to play the guitar by himself, which I think makes his music just super pure. Like it's beautiful. It's beautiful.
Amazing. That might be the coolest one that I've had suggested the whole time I've been doing this. So I keep saying at some point I need to do a playlist of all my guests' favorite artists. So I will. That's a good one to add to the mix. And Paulina, thank you so much. This has been an awesome conversation. I can't believe how fast this went. What's the best way for people to reach out to you?
Probably LinkedIn, or of course we have our Schenker Ventures website. We also have the Schenker Ventures LinkedIn site. I would be thrilled if we would gain followers. Yeah, we are working hard on this one. And yeah, just reach out. Happy to talk to you guys.
Great. Well, thank you. Have a great weekend, and we'll talk soon. But really appreciate your thoughts. It was great to see you again, and all the best going forward.
Thank you so much, Eric. Have a good one.
Thank you. Bye, Paulina. Fantastic insights into VC, especially in Europe, especially from a massive global 3PL. Stat joke of the week time. Ready?
Why are stadiums so cool? Because there are a lot of fans. That one is straight from my son. Again, direct any complaints to him. I have nothing to do with it this week. I'm just a messenger. I did not come up with that one. But you're free to use it if you groaned in the background. I want to say thank you once again to everybody who came, attended this week. Always appreciate the support for the show. Love doing it for you. Any suggestions, shoot them my way. Follow me on Twitter, LogTech Eric. If you're not already following me, I'll be back, I swear, in 3 weeks with a new LogTech letter on my Substack. I hope to see a lot of you in Long Beach next week and the week after for TPM and TPM Tech. And thank you to Sarah again. Thank you to my producer, Nicole, who makes my life so ridiculously easy. And one last thing, blended pledge. Make the pledge yourself. Get your company to support this in a big way. Own this initiative so people know that this company is helping to create better diversity in our industry on stage. Thank you, everyone. And we'll be back in 2 weeks with a post-TPM wrap-up that you're not going to want to miss. So definitely dial in on March 3rd, 10 a.m., same place, same time. All right. Bye, everyone. Have a great weekend.